Good morning, everybody. Welcome to our Thursday discussion. Thanks for joining us this morning. We're going to be discussing Nedbank. As usual, the disclaimer that says that we, as much as we try to give you correct information, we by no means warrant that it's or imply that it's correct or construing investment advice, and you'll have to check your own personal situation before buying and selling shares. We all know it's volatile and the market's tricky. So just wanted to highlight that. And today we have Pierre Muller, who's our banking analyst, and he's going to be chatting to us about Nedbank and their recent set of results. So I'm going to hand straight over to Pierre, and he can take it away.
Thanks, Sarel. Good morning, everyone. So yeah, we're looking at the half-year results of Nedbank. Starting off with just the overall environment, we can see on most banks, the African exposures benefiting quite well. There's strong growth on that side. This is seen as a bit of a normalization, I would say, after COVID. And then a bit of an opposite side. On SA side, we're seeing a bit more on the credit impairments ticking up there, as especially on the consumer side of things. So the interest rates still benefiting most banks, even though these impairments are ticking up, they're still benefiting more so from the net interest income at the moment. And it seems like most management expect the interest rates currently to be at the type of peak levels for South Africa, and then decrease with cuts probably from the next year from the first half. And therefore a better consumer maybe in the second half of next year. So Nedbank, on the valuation front, its PE is below its historic average. It's also trading at attractive dividend yield, is 8 to 9%. They've also increased their interim dividend by 11% in line with this headline earnings increase. We, however, have currently a hold recommendation on Nedbank, and that's purely based on a relative basis compared to some of the others. And also a main reason there, it has quite lower profitability compared to the other banks. If we look at a return on equity, which they have, is currently below their cost of equity. So if we turn to the next slide, we're going to talk to the results. What happened now in this half-year results specifically. Headline earnings was up 10%. So this, what we think is slightly a bit better than what was guided with the muted earnings growth. The revenue was up 14% ahead of the operating expenses growth of 7.5%. So that would increase your profitability ratios, such as your cost to income and return on equity, as we see there. So the main driver being the net interest income, we can see that 18% increase driven by the average interest earning assets increasing 9%. And then also that net interest margin expanding from 385 basis points to 418 basis points. Then the deposits, they had an 8% increase, and we can also see a shift to longer tenure deposits, such as your term deposits. And on the impairment side, that increase was mainly in the retail and business banking segment, and specifically the SA consumer segment, as mentioned. And then looking at the type of products for Nedbank, it was mostly on the mortgages and also some on the term loans. As we can see, the increase there in the provisions was faster than the increase in the gross loans. Management guided the net interest income to be up slightly above mid-teens, the non-interest income to be up about mid-single digits for the full year, operating expenses to be mid to high single digits, and then the credit loss ratio to be above the through the cycle range. So the top limit is the 100, but they see an improvement from this current loss ratio of 121 where they're currently at. Then on the next slide, we look a bit deeper into the net interest income. Yeah. can we just move to the next slide, Sarel, please? Thank you. It shows now on my screen. So yes, being the main driver currently, the net interest income. So Nedbank doesn't make use of hedges. So that's basically managing a bit of your interest rate exposure, to put it simple. So some other banks do. So they are exposed to this rising interest rate cycle, and their argument is because there's a kind of a natural hedge built into the credit losses. So as you get more interest income, you and the impairment goes up, they kind of set off against each other. So there we can see a nice expansion in the net interest margin due to this endowment impact. So that's the rising interest rates. There was some slight negative impact, however, on the asset side, so the mix and pricing. So the pricing side just on a competitive environment, and on the mix side, they purposefully shifted a bit or a bit more prudent on the credit cards and the personal loan side, being your higher risk type of items. So lower growth there. So that shifted away to more safer assets, also meaning lower yielding assets. So that's why you also have a bit of a negative impact there. And then the guidance there at the bottom, so I took that from the Nedbank presentation. You can see what they're expecting. So with the interest rates going lower, possibly in this first half next year, so then that would have a negative impact looking forward on the endowment impact. However, they expect the credit loss ratio to also improve already in the second half this year, and then again in the second half of next year. They also mentioned that they expect the inflation first to help the consumer and then the interest rates. Then looking at the non-interest revenue, so there was a bit of a couple of funny accounting things and fair value adjustments that drove the earnings here. There was also some just currency, so USD assets, USD dollar assets and Zimbabwe, and so that create some growth. But then looking at the main type of revenue items, so your net commission and fees income and trading income, so this was up 4% and 2% respectively, even though they did cite a nice 11% increase in main bank clients. And this was substantiated a bit by the admin fees growing by 9%. However, the other fees didn't increase so much, as we see the expenses side increasing a bit faster than the income side on these commissions. And then on the trading income, the equity side had a bit of a difficult environment. Then on the operating expenses, so staff costs being the main expense for all banks, so they actually decreased their headcount by 2%, but then the increased performance in the results, that's driving the incentive side, so increasing there, but then also the higher salaries would have been your annual increases coming in, and a bit of a mix effect from when you have a bit of more expensive employees. Otherwise, we've seen some IT projects coming to the end of their terms, and therefore the cost that get captured and amortized there is kind of slowing down, and some normalization in things like advertising and travel and so forth. If we go to the next slide, just looking at the Africa exposure and the history here, so we can see almost 10 years going back. So for Nedbank, they have a reasonably smaller Africa exposure, and historically for the past 10 years, it has been about 3%. It's going to 7% of the headline earnings in the prior year and 15% now. So a lot of the growth and we've been seeing that's been doing tremendously well is also on the African side. But however, we expect it to lose some momentum if you just consider this first half is almost the same as the previous year. So if you double that up just to get to a full year, so we have basically doubling the earnings, so we can't expect that going forward. So it should slow down the momentum. And then lastly, just looking at the credit loss ratio and the coverage. So to put it simple, the below line reflects the expenses coming through on the income statement, while the above dark line is the provisions that they have. So where they can utilize this to reduce any impairments coming through in the future. So they've already provided for, you know, the black line at the top. So if we just consider this, you can see the black line, the provisions being a lot higher than the past 20 years, the expense side. So this also supports that view of a second half, a better credit loss ratio. So improving on that side. So I'm expecting they will be able to utilize this coverage, which they already provided for, and sitting in there. So that provides some buffer into the possible future impairments. And then looking at the price performance. So in the 3 years and shorter time periods, Nedbank outperformed. And then lastly, the next slide, just on the valuation front. So we have an intrinsic value of 262. So this was 11 August. We had a 14% upside. I know the share has been selling quite down this week. So it's I think somewhere in the 20% upside now. And as mentioned, if you look at the historic pricing multiple, so PE in this case, it is at the lower end of that range. Yeah, thanks. That brings me to the end of my presentation. I think we can do the technical chart and then maybe switch to questions if that's fine.
Yeah, good morning, everybody. Yeah, we can see the chart of Nedbank there. It shows the share price is trading far below its 21-day and 40-day moving averages, as well as the 200-day moving average. So I'm calling the medium to long-term trend, I'm calling it bearish, turning bearish. We still need confirmation. There's a 21-day, the red line will cross over the 40-day moving average to give that confirmation. Saying that, the share price has recently obviously fallen below that, call it the previous resistance support level, around about the 251 level. I was expecting that it would have been offered some kind of support or turning point, and we've seen it drop right through that. It's trading around about 209 at the moment this morning, so it's taken a bit of a whop this last week. The next support, as you can see there, is way down there by 203. So it could still pull way down there, and that bearish price action is confirmed by the that lower technical indicator at the bottom there called the MACD. You see it's moved into oversold territory, but there's no clear buy signals at this point in time. So you know, I'd rather be prudish and wait more for a definite change in trend rather, and some confirmation from other technical indicators. As I say, they are. The share is trading very oversold. It is an oversold territory there, also with like the stochastic and the RSI. But you know, as Pierre said, now you know the intrinsic value is at 262. Got a hold recommendation on it. It's got a lot of upside, more than 25%. So, but at this point in time, I don't see any buy signals. But it's still an opportunity. Thank you.
Oh, thanks very much, Shaun. Thank you, Pierre. Before we go into the Q&A, I just wanted to add to Shaun's chart here. If you look at it from a technical analysis perspective, you'll see very long red bars over the last couple of days. And we have to remember that it was external, that influence, in the sense that all the troubles that's brewing in China and in the economy, and nobody having certainty about what is actually going on in the Chinese economy, has spilled over into the markets, and we've seen a massive sell-off across the board in global markets. So I think it's just taken some pain on the back of that. All in all, for me, Nedbank, if boring is your scene, then Nedbank's your bank, because I think it's a solid set of results. We do favour FirstRand and ABSA for higher growth and better expansion into the corporate sector and so on. But I mean, Nedbank, Pierre, you can correct me, but I think this is not a bad set of results if you look at it, and you've got a dividend yield of almost 9%. A nice solid share that sort of as Shaun's technical show here, over a very long period, it's traded in a slightly, it's a tight range, 200 Rand to 240 Rand. So whilst the share is not growing and the share price not rising a lot, you do get a solid dividend yield. I'll now open the floor for questions. You can ask your questions in the chat, or you can ask them by switching on your microphone or your video for us, so that we can put a face to the voice. It'll be nice. If there are any questions, I'm going to stop sharing now and hop straight into the chat. Let's see what's there. Righty. There's a question. Clive says, thanks, Pierre. Good presentation, as always. Yeah, I think it's very comprehensive, Pierre. Thank you. There's not a lot of things that I did want to ask. You sort of highlighted them along the way. Do you know what share the presentation will be on next week? Clive, I'll go check for you quickly, but I think it's Impala. Let's see quickly. Whilst we're waiting for some more questions.
No, it's Standard Bank. You'll be
is it
seeing
Standard
my
Bank
face.
next week? Okay,
Yeah,
great
you'll
stuff.
be seeing me again.
Okay, great stuff. All right, so we're doing Standard Bank next week, Clive. Something you've got an interest in. Richard says, what's the div yield for First Rand and ABSA? Pierre, do you know what?
No, well, yes, but so the dividend yield for ABSA is 7.6%, and then for First Rand it's 5.3%.
Okay, so Ned's got a slightly higher dividend yield than the others. Right. Clive says, thanks, Sarel and Pierre. Any other questions, guys? Doesn't look like it, Pierre. Looks like you've got it covered, right? I want to remind you, people, we set out and we said we're going to do the derivatives workshop, and that's going to take place tonight at 6:15. If you did not get the invitation, I mean, you should have, because I sent it on the same email as I sent it on to the same audience as this invitation goes to. If you want to attend, please just register for that webinar. Otherwise, you're going to have to register before you come into the room and so on. We look forward to hosting you tonight, and it's going to be a very interactive discussion. It's not going to be a presentation, and I'm not going to give you a lecture. I think we'll take questions from the audience as we go, and the more questions we have, that's the best way to learn. So I want to invite you that if you join us tonight, get yourself a question, something that bothers you, and we're going to fire away with questions straight away and explain it that way, to see if we can help each other along and get a good grip of how the derivatives can help us to do various things to our financial portfolio. All right, let's see. Tebogo says, your comment on FNB and ABSA and Standard Bank next week. Can we have a comparison of the banking sector? So what we'll do, Tebogo, is we'll get Pierre to finish his banking sector thing off at the bottom of his slide with maybe a summary of the dividend yield of the banks and the latest results and so on, so that we can do a slight comparison, maybe intrinsic value versus share price, and see who's got the biggest growth opportunity and so on.
I thought about I'll include something just like a main table of the main things. Especially we'll be looking at something like the provision operating profit. So that takes away a bit of the impairment, because that can be quite volatile from bank to bank, because there's a lot of judgment used by management. So just to get some comparisons and put some perspective on what I think the differences are on the banks and going forward. Yeah.
Right. Okay, Nolan, very good question. Nolan says, I've not received the link. Where must I register then? And Nolan, I should have placed it in the chat here for you guys, but I think it's going to be easier if you pop me a mail and I send it back to you. So my mail address is sarel.snyman@psg.co.za, and I'll make sure you get the link and send it to you guys so that you can register for tonight. I'm going to start at about 6:15, and I've booked it for an hour and a half, depending on how many questions we have. But we should finish within an hour. Looking forward to hosting you guys there as well. All righty. If there are no further questions, then I'm going to close it. Pierre, thank you very much for your good work. Very insightful and very comprehensive. Thanks very much, mate. Thank you, Shaun.
Thanks, sir.
Have a good day, guys. Bye-bye.
Cheers.